Gold is surging in price, the US dollar is dropping in spending power, and interest rates are at high levels. As people are grappling with everything going up in price, Peter Schiff, an American stockbroker, financial commentator, and radio personality who predicted the 2008 financial crisis, cautions that the surge in gold prices should serve as a signal for the Federal Reserve to consider raising interest rates to avoid a worse economic collapse than in 2008. Peter Schiff cautions that the surge in gold prices should serve as a signal for the Federal Reserve to consider raising interest rates, particularly if it adheres to its data-driven approach. He contends that if the Fed genuinely prioritizes its data dependence, the escalating gold prices would logically prompt it to increase interest rates. Gold is telling you rates are too low. When you purchase gold, you're opting for an alternative to holding US dollars or US treasuries. What's happening is that foreign central banks are trading their dollars for gold. But why are they making the shift? They're giving up the opportunity to earn interest on treasuries in exchange for holding onto gold, which doesn't generate interest. The primary reason behind this decision is if they anticipate that inflation will outpace the interest rate. In such a scenario, they would experience a negative yield, resulting in a loss of purchasing power if they stick with dollars or treasuries. Consequently, they're selling off these assets and acquiring gold instead. Consider the significant surge in gold prices during the 1970s, skyrocketing from $35 an ounce to over $800. This notable increase wasn't a random occurrence. It coincided with a period of substantial inflation. What was gold doing when we got off the gold standard? Moving the US dollar off gold allowed us to increase the money supply significantly. Yet it wasn't gold that experienced a surge in value, rather it was the dollar that depreciated. For instance, consider oil prices. In 1970, they stood at around $3 per barrel, while by 1980, they had soared to $30 per barrel. The crucial disparity lies in the payment method. In 1970, oil transactions were settled in gold, whereas by 1980, they were conducted in paper currency. Thus, it wasn't that the price of oil itself escalated. Rather, it was the diminishing value of the currency we used for transactions. Consequently, we found ourselves compelled to fork out more dollars to procure the same quantity of oil. The increased participation of women in the workforce. Peter Schiff's observation regarding women's participation in the workforce during the 1970s. A significant factor driving the influx of women into employment was inflation, which eroded the value of their husbands' earnings. As inflation diminished the purchasing power of men's paychecks, women found themselves compelled to seek employment to bridge the financial gap. Additionally, rising taxes fueled by bracket creep induced by inflation further exacerbated the financial strain on households. It's essential to dispel the notion that women entered the workforce purely out of liberation or desire. Rather, many did so out of necessity to meet financial obligations. Reflecting on this period, it becomes evident that the surge in female employment served as a vital lifeline for families, providing an additional source of income. However, this dynamic has evolved over time. With most households now relying on dual incomes, the landscape has shifted. Consequently, the current challenge lies in how individuals are coping with inflationary pressures. Examining monthly jobs reports reveals a proliferation of job opportunities, seemingly a positive indicator. However, a closer inspection reveals a concerning trend. These positions are predominantly part-time, while full-time employment is dwindling. Moreover, these part-time roles often go to individuals already holding jobs, indicating a reliance on multiple sources of income. Moonlighting or taking on additional employment has become increasingly prevalent, driven not by choice but by necessity. This underscores the precariousness of the current labor market. The proliferation of part-time roles and the necessity for individuals to juggle multiple jobs paint a bleak picture of economic stability. In a robust labor market, one job should suffice to meet financial needs. However, in the face of a weakened labor market, the reality is starkly different. Individuals find themselves needing 2 or 3 jobs simply to make ends meet. This reality underscores the fragility of the current economic landscape and highlights the urgent need for sustainable solutions to address these systemic challenges. And the other way they're doing it is with debt. People are taking on debt. Even though credit card interest rates are at an all-time high, you would think, okay, people will borrow less because it's so expensive. No, they're borrowing more, over $1.1 trillion right now. the potential for a devastating economic outcome. Worse than 2008. We need to recognize that the pivotal moment began around 2001 and 2002, following the burst of the dot-com bubble. That's when the Federal Reserve initially reduced rates to 1%. Greenspan also made several policy errors in the 1990s, contributing to the expansion of the stock market bubble. However, the policies reached a critical point around 2001 and 2002 with the rate cuts that paved the way for the housing bubble, ultimately leading to the financial crisis of 2008. However, each time the Federal Reserve instigates a misallocation of resources or fosters a malinvestment bubble, it exacerbates the situation. Instead of permitting the market to fully rectify the past mistakes, the cycle perpetuates. In the business cycle, characterized by its boom-bust pattern, errors accumulate during the boom and corrections occur during the bust. Allowing the market to function naturally is imperative. Yet, in the short term, this process is painful, as individuals experience job losses and financial setbacks, which is unpopular among voters. Consequently, there's consistent political pressure on both the government and the Federal Reserve to combat recessions, despite the fact that recessions are often necessary for recovery. Attempts to counteract recessions only exacerbate the underlying issues, akin to making the disease worse by treating its symptoms. However, their approach results in perpetuating inflation, essentially deferring the inevitable pain. Each instance of this tactic exacerbates the underlying problem, amplifying the eventual suffering required for resolution. Therefore, we find ourselves at a critical juncture where the Federal Reserve must choose the lesser of two evils. On one hand, it can combat the inflation it generated through measures like quantitative easing, QE, and expanding its balance sheet. However, this approach necessitates raising interest rates significantly beyond current levels. Such a move would compel substantial cuts in government and household spending. Currently, our entire economy hinges on spending, effectively existing within a bubble. Consequently, to address inflation, a significant recession must be initiated. It's not that recessions are inherently required to combat inflation. Rather, the actions necessary to address inflation will inevitably trigger a recession due to the fundamental nature of the economy. This recession, marked by a housing market crash and a stock market crash, will bring about a wave of defaults and failures. Unlike the response to the 2008 financial crisis, there cannot be any bailouts this time around. If a bank fails, it cannot be rescued. It must be allowed to collapse, and depositors must incur losses. There simply isn't enough funding available to bail out depositors. They must bear the consequences of the bank's failure. The government is confronted with the daunting task of informing individuals reliant on Social Security and Medicare that current financial constraints prevent them from meeting payment obligations. This isn't merely about future adjustments, it's an immediate issue. The checks being dispatched presently cannot be sustained at their current levels due to insufficient funds. Social Security, including its purported trust funds, is already resorting to selling treasuries. Moreover, Social Security's revenue intake falls short of its expenditure, rendering it financially unsustainable. Consequently, the government must inform pensioners that it cannot fulfill pension commitments due to financial insolvency. Presently, the government faces a staggering annual deficit of approximately $3 trillion, potentially nearing $4 trillion. Even substantial tax hikes on the middle class wouldn't suffice to alleviate the financial strain. As a result, significant cuts to government spending are imperative. Unfortunately, these cuts will disproportionately impact individuals reliant on Social Security or those who have lost their savings in failed banks. In reality, if the Federal Reserve were to earnestly combat inflation, it's plausible that we would struggle to meet the interest payments on the national debt. Presently, our expenditure on national debt interest stands at approximately $1 trillion annually. However, should the Federal Reserve opt to raise interest rates to levels necessary for addressing the short-term nature of the debt, within a few years we could find ourselves allocating $3 or $4 trillion annually to service the debt, potentially consuming all tax revenue. Naturally, we cannot feasibly simultaneously slash funding for Social Security and Medicare while honoring our obligations to foreign creditors. Simply put, that course of action would prove untenable. Conclusion. Thus, the inevitable outcome would be default. We would have to inform our creditors that we cannot fulfill our debt obligations in full. Perhaps we could offer to repay them at a reduced rate, but these are the harsh realities we must confront if the Federal Reserve truly pursues the necessary course of action. However, politically, this proposition is a non-starter as it would entail imposing tough decisions on policymakers. Therefore, the alternative is to allow inflation to persist unchecked. While authorities cannot openly admit to this strategy, they must maintain the facade of having done enough and claim that inflation is receding. Yet, in truth, they have conceded the battle, recognizing that the repercussions of fighting inflation would be too severe. Consequently, we will experience runaway inflation, causing the value of the dollar as the reserve currency to erode. Social Security benefits will diminish in real terms, and bondholders will suffer losses as their holdings are inflated away. Ultimately, inflation will impose greater losses on government creditors than alternative scenarios such as devaluation or economic depression. Nonetheless, politicians prefer this route because it postpones the pain and allows them to deflect blame onto others, typically blaming inflation on the private sector. However, the primary source of inflation lies with the government and its collaboration with the Federal Reserve.